Well, hello, everyone, and welcome to the September monthly market update from Principal Wealth Partners. I'm Julina Ogilvie, partner and wealth advisor here, joined by Bob Paolucci, our founder and CEO. Bob, welcome.
Hi, Julina.
Welcome to the fall. I'm trying to hold on to summer here with my white jacket, as you quickly noticed this morning.
Yeah, you're a day over the limit, I guess.
I guess I am. So before we kick off this presentation and address what we want to talk about today, I did want to point out that you have a title to this presentation, and if you could maybe explain to everyone what this title means.
Sure. Navigating by the stars with cloudy skies is a statement that Jerome Powell made at the Jackson Hole meeting, the vacation Fed meeting last month, where they divulge a little bit more information than you typically get at their structured meetings. They sound 10% more human with their statements, and they get a little bit more granular. And he said, look, we are trying our best. We're trying to do something very difficult. It's like navigating by the stars with cloudy skies, in essence saying we are trying to not put the economy into a recession while indirectly trying to slow it down. We're trying our best. Bear with us.
Right.
And I thought that comment was, a great comment and a very honest comment. Finally, they sounded human.
Exactly. Yeah.
So, and we'll go into some of the data that he's looking at, our opinion, over the next few minutes or so.
No, that's great. Thank you. And I think on that note, we have 6 points that we want to address today. Some of these are questions that have come up from clients, but again, to your point, to kind of solidify some of the message that we're seeing. The first one, being pullbacks are common. We talked a lot about the second half of this year being a lot more optimistic than the first half or even what we saw last year. But that's not to say you don't have pullbacks along the way.
Absolutely.
Yeah, and the second one is the seasonal patterns as we're leaving the summer and going into the fall and towards year end. There are some seasonalities that we find, so we'll address that as well. And then the third one is interest rates, the real market mover, if you want to comment on that.
Yeah, it's the bond market and interest rates, right? They always say it's the smart money. And if you want to know what's going to go on with the stock market, look at the bond market first. Usually gives you very important signals.
No, absolutely. We also are going to quickly address the Federal Reserve status quo, meaning what you had mentioned for months and months on these videos about pausing. We think we're finally there.
Yeah. And it sounds like the Fed is there as well.
Yeah. Okay. We'll go through that. A new topic is China, the world's factory, you call it.
Yeah, it is the world's factory. They produce everything for just about everyone. Shockingly, they have been exporting deflation to the rest of the world, and we will illustrate that to you shortly.
Okay, great. And then finally, a topic that comes up a lot is real estate. I like your little equation here: real estate minus building equals built.
Yeah. So ultimately, we're hearing a lot on TV about the massive amount of single family and multifamily building that's going on throughout the country. And yeah, that's actually happening. Toll Brothers and D.R. Horton and all these big national builders are saying that they can't build homes fast enough. Okay. But what happens when they're built? We'll get into that a little bit.
Okay. That's great. Thank you.
Yeah.
So I guess let's start with the first bullet point, talking about pullbacks and how common they are.
Yeah, very common. So this chart here, the top half of the chart, in essence, is the bull market that started in March of 2009, ended in February of 2020. It's about a 400% increase in the S&P 500. That's the top upward arcing line. And the chart below it is a drawdown chart. And, different scale. So small declines look a little bit bigger. In essence, it's magnifying the little blips that you see on the upper line, the little downward blips. And we've drawn two lines. One is a 5% drawdown line, and the second is a 10% drawdown line. What you see here is time-wise, this matches the bull market, 5% and 10% drawdowns are common. 5%, happens almost every quarter, should be expected to happen every quarter. And 10% drawdowns, you get on average about one of those per year. For people listening, the stock market had a negative month in August, really to be expected. Part of it's seasonality, part of it was interest rates rose a little bit. And part of it is, the stock market's in a bull market, so it has to take a breather every once in a while. And August was those once in a while months. So completely normal, should be expected in a bull market. Very healthy when we get 5 and 10% pullbacks. When we don't, it's actually considered very unhealthy because the give back that the market will experience is usually larger than average. So we like to see these 3, 5, 7% pullbacks from time to time. It helps the market breathe.
Yeah, absolutely. It is amazing that this has been considered one of the most robust decades in the market that we're looking at here with this 400% return. And yet you had, I think I calculated 21 corrections between -5, more than -10% during that time. So
yeah, right.
Again, it's just the way the market breathes.
Absolutely. And we're going to hammer this point home over the next couple of slides.
Okay.
So, another view, maybe an easier to visualize view of these pullbacks. So here you go. According to this chart, it's about 3-5% pullbacks per year for the S&P. Completely normal. Should happen all the time. Next chart will show you a little bit more granularly what it looks like. So when you do have a 5% pullback, they end up stopping around 8.25%, right? So once you pass that greater than 5% mark, on average over a long period of time, this goes back to 1927, the typical drawdown, assuming it gets to greater than 5%, ends up being about 8.25. Again, happens all the time, completely normal.
And can I just quickly point out that this is a great reminder with the fact that when the media likes to highlight this and what happened in August, they are making it sound the opposite and that it's not normal and that this is very extreme.
Well, and the headline sounds like this: we're having the worst month in 3 months.
Yes.
Or we're having the worst week since last week.
Yeah.
Or we had the worst day since, 11 days ago. The headlines make little sense. But again, they have to fill their time with something. Why not make you feel bad? That's how you gain viewership.
Sure. Of course. Okay. Thank you.
Then there's us. We're just trying to show you the truth. Again, here is the spreadsheet view of all the declines in the last bull market. There's always something to worry about. If you just look at this chart, you'll forget that the market multiplied 4 times during that bull market. And here are the drawdowns. There's one year where there actually wasn't a drawdown of greater than 5%, and that was 2017.
Right.
That was, a year for the record books. That was the lowest volatility year in the stock market, I believe, ever.
Yes.
But you got to go into the time machine to remember that. So again, here is the view. The drawdowns of an abnormal bull market, or really good bull market. These are the drawdowns. Right. So expect more of these over the next 6 or 7 years, completely normal.
Yeah. And I'd also point out we had 2 drawdowns more than 20% back in 2011.
If I'm going to get nitpicky with this one, this is a chart that illustrates this is just a crazy data point, but ultimately this is intraday moves of the market. So it's measuring where the market was point to point intraday. This is not on a closing basis.
Correct.
If you did it on a closing basis, I say this because all the technical charts use closing basis. The 2011 20.77 becomes 19.99, and the 9/21/2018 becomes 19.92. So on a closing basis, there were no 20% declines. I say that because 20% decline on a closing basis is actually a bear market. And that did not happen.
Right.
This is measuring intraday pricing.
But you can come close. So that's a good point.
Absolutely.
So let's talk about some of the seasonality.
Yeah, the summer patterns, right? So August, you can see historically, here's month over month, past 50, 20, 10 years. We even threw in pre-election years. You could see that August is not a great month for the market. September is usually a negative month
Mhm.
for the market. So the seasonality of August and September, that we always call it Wall Street going on vacation,
Yeah.
and then coming back mid-September, rebalancing. Usually during a bull market, it rebalances to sell some stock, buy some bonds,
Hmm.
and then October, November, December get a positive jolt, which
Yes.
which also bleeds into January as well. So the fourth quarter typically of the year, certainly in bull markets, tends to be the best quarter of the year. We have that to look forward to once we get through the choppiness of September. I will say there are a few things that might make September as choppy as prior Septembers. One is the auto workers strike. Two is the chance of a government shutdown. It'll create a little bit of volatility on top of the normal seasonality, but ultimately we view those if they are negative, we view those as buying opportunities.
Great. Thank you. Now, this slide probably needs a little explaining.
Yeah, one of my favorite slides. I think this is one slide that you can use to really understand whether or not the market is cheap or expensive. And it's really the relationship between 10-year treasury bond, the benchmark interest rate, and the valuation of stocks. And generally speaking, this chart's very simple. It just says the higher the interest rate of the 10-year benchmark treasury bond, the less you should pay for stocks. You should get a lot more earnings for stocks when the 10-year treasury yields more.
Yeah.
So companies need to work much harder to grow their earnings than when rates are at 0, 1, or 2%. So when rates are lower, the multiple, the price to earnings ratio on the stock market, can be higher,
Hmm.
which means the market can also go much, much higher. When interest rates go higher, the multiple should come down.
Yes.
And this is a really good chart to remember whenever the markets are volatile,
Yes.
because it tends to be very accurate all the time.
And I think based on that's why it's called this scatter plot, right? Because it's showing historically that correlation that's
Mhm.
tying to that black dotted line. And to
Mhm.
your explanation, we started January of 2022, all the way in the upper left in that maroon bubble. And we've moved down to the light blue. And as yields have risen, right, follow that black dotted line, you can see the price to earnings dropping.
Absolutely.
Yep. If that helps from a visual standpoint. So it's a very, very important concept. And sometimes people look at this slide and they just shut their eyes. So
They do. And I would say this is probably the single most important thing to understand if you're investing money, because it is so accurate.
yeah, no, that's great. Thank you for going through that.
Sure.
So let's talk about the Fed pause.
Yeah, so this is the Chicago Mercantile Exchange, where you can bet on the decision of the Fed. And right now, you see a 93% chance that the Fed pauses in September. And then there isn't a meeting again until October. You can see in small print there's a 7% chance right now that the Fed increases rates by a quarter. The odds are they don't. So what you're seeing here is the market is not expecting the Fed to increase interest rates. And I would say if you're looking at two meetings which span 3 months, the Fed is done. In a presidential election year, they will not be increasing interest rates. More often than not, they decrease interest rates.
Okay.
So if we don't have the Fed act to increase by another quarter
Right.
before the end of this year, you you can be sure that the Fed is done. We think the Fed is actually done. We've been saying this for months now.
Yeah.
The Fed snuck in a 25 basis point increase, a 0.25% increase in July. At the same time, they said they are pausing. So we think they are done with this cycle that started in March of 2022. We think it's unofficially official. And in the coming months, the Fed will make it official. Probably without saying, they're going to try to say it without saying it, that they're done.
Mhm.
And the next thing they'll talk about is keeping rates where they are for some time. And then they'll be forced to talk about cutting rates, which we think will happen, at least for now, sometime in the summer of next year. If Washington doesn't pressure the Fed into doing something in the spring.
Okay. Yep. That's a great point. And let's talk a little bit more about the inflation, because we've spent a lot of time talking about this as one of the drivers of their Fed action.
Yeah, in the same meeting that the Fed had at Jackson Hole last month, actually just a few weeks ago, the Fed reframed their data points. They keep changing their mind with their data points. They said, housing is something that they're looking at. They think it's slowly rolling negative,
Mhm.
and we're going to prove that in a second, which helps the overall inflation number arc negative or into a pretty significant decline soon. And jobs, they want to see fewer jobs created and fewer available jobs.
Yeah.
The other one they threw in was consumer spending, and that is showing some signs of slowing. But again, it's a lot of it has to do with jobs and also housing, which soaks up a lot of money. So here is our inflation measurement in this country minus shelter. And you can see it has, let's call it crashed down to a very normal level.
Yeah.
So this is minus shelter. Let's go to the next slide and show just shelter. So housing only, the two ways they calculate it. Rent to primary residence and owner equivalent rent, both are rolling over.
Yeah.
And these are incredibly delayed data points that the government somehow still uses. But you can see here that blue line is arcing negative. The green bars below it are the 3-month percentage change.
Mhm.
And you can see the 3-month trend is significantly lower, even lower than the print that's out there. So housing is likely going to be the inflation data point that pulls all the inflation measurements down in the coming quarters. We will see more of that monthly, but we expect to really see the benefit of that, at least to the inflation data, starting in the first quarter of the new year.
Okay. Because this information is so
So
lagging.
delayed, so
Yeah.
delayed.
Absolutely. That's a great point. We haven't really talked about China, so let's talk about the world's factory.
Yeah, the last time we talked about China, our argument was a counter argument to, hey, China's economy is going to reopen. China, the country, is going to reopen. That might be inflationary for the world. Our argument was, how can that be inflationary for the world? They're an export-based economy. They make stuff for everybody.
Right.
So if they're making stuff and shipping stuff, that means the supply chains are better. That means prices go down. And that's exactly what happened.
Yeah.
So here is the world's factory, China, who makes stuff for everybody and exports it to everybody. Here is their inflation index, which is in orange.
Mhm.
And we match that with our producer price index, PPI, which is wholesale prices.
Mhm.
Um, Boy, do they look similar.
Look at that correlation.
So wholesale prices are down because China is exporting a ton of stuff.
Mhm.
They're almost synced one for one. You could see that China's inflation data is zero, and our producer price index is less than 1%.
Right.
That is one of the leading CPI indicators. So once you see producer prices coming way down, CPI comes way down, usually within a quarter or two. And we've obviously seen our inflation number come down pretty significantly. And we think there's even more room to run there. So,
Another great point for the Fed to consider.
yeah. This one's interesting. So, if you listen to the talking heads on TV, you got to go global. You got to have more money internationally invested at least. So, this is a wacky chart. China's economic growth, again, it's a communist country. They can say whatever they want to say, but we've heard them say that their economy grows like clockwork at 6 to 7% every year, and that's been the case for the past 15 years. Who knows if it's true? But there is one factual line on this chart, and it's investing in Chinese companies, and that's the purple line. So 15 years ago, if you put $1 into the China index fund, you would have less money today. You would have about 98 cents 15 years later. That's compounded. Doesn't factor in inflation. That is just raw dollars. It's been a money losing investment for a very long period of time, even while their economy has grown by 3 times, almost 300%.
That's the
Uh,
orange line.
yeah, stocks invested. So investing money in their stock market has generated no return over 15 years. So, you know, for many clients listening, there's a reason why we have been for a while underweight foreign investing. Some of the big weights when you invest internationally are China and then Europe. They haven't really done much.
Right.
Here is just a shocking evidence of it. And I think this will be eye-opening to a lot of people that see this chart, as it was for us.
Absolutely. I mean, if there's ever a line that I thought was manipulated, I have to say it's that orange line. I've never seen anything like it.
Absolutely. So, I mean, if this is true and their economy really did grow, the difference between their market and their economy is the fact that they're a communist country and their government has taken most of the profits.
Right.
It's as simple as that. That's where the money goes.
Okay.
If the top line is true.
If it's true. Yeah.
Yeah. The bottom line is true.
Yeah.
Not sure if the top line is true.
Okay.
Anywho, interesting data
Big
point.
question mark.
Yeah.
And lastly, we have real estate. This is always top of mind with people.
Yeah, we'll talk about real estate, right? It's when the economy strengthens, it's usually first seen in housing. When the economy slows, it's seen in housing. So right now you have housing at a very unaffordable level, right? Interest rates are very high, prices are still very high. That doesn't add up to a very affordable housing situation.
Sure.
Looking back roughly over the past 30 years, you could see that affordability is at a 30-year low, and that's not good for housing going forward.
Yeah.
We'll show you the next chart. You mix that with a tremendous amount of under construction projects, high interest rates, projects that were started when rates were lower, mixed with very likely to start, the purple line there, not started, but the plans are done, the permits are pulled, they just haven't broken ground yet.
Yeah.
You have a scenario where next year, potentially for the next 2 years, you could actually have a lot of homes for sale, and that brings prices down. So if you go to the next chart, you could see that supply this year is incredibly low.
That's the
yeah, a good chunk of that is driven by the fact that the average mortgage has a rate of less than 4%. And, if you're looking to move on and move up, you'll have to sell that house and the less than 4% mortgage, buy a more expensive house, and lock into a 7% mortgage, which is absolutely astronomical and mathematically hard to swallow. So even though you may have made money on the home that you purchased 5, 6, 7 years ago, 10 years ago, even, when you do the math, the affordability math, potentially a slightly smaller mortgage on a much bigger or nicer property,
Hmm.
but the finance cost has tripled, almost tripled.
Right.
You are looking at a payment that, will knock your socks off. So you have this very low level of listings, very low level of inventory, about 50% lower than the average level over the past 5 years. So that has kept prices relatively high in the real estate market. If we have all these homes being built this year, to be done next year,
Hmm.
you're going to see a lot more inventory, and you're still going to see relatively high interest rates. You might see some price declines next year, potentially for the next 2 years. Not everywhere. Location is key. But I think the national average will very likely show a housing price decline next year and potentially the year after.
Okay. Yeah.
So more to come on this. We just mentioned it now because it's something we're looking a little bit more closely at.
Yeah. No, that's great. Thank you. That's it. I think, I think what's important about today's message is a few things. One is expect pullbacks. When you look at the seasonality of where we are this year, just because you see a pullback, it doesn't mean that we're still not positive in terms of the fundamentals of the market. And then the third point is, this Fed pause that we've been talking about for a while. Again, some other great points to help justify why they may be ending at this point.
Yeah, we're in a bull market. It's real. The Fed is almost done. If you think about the tailwinds that we will be facing over the next year or two, they should more than offset any of the headwinds that we'll be talking about over the next couple of quarters. Not to mention, earnings forecasts are every month pushing higher and higher and higher,
Mhm.
and that is certainly helping push the market higher and higher and higher. So all good news. We
Yep.
figured some of these monthly videos that we do will uncover the stuff behind the scenes in the market, the economy, housing, the Fed language, so on and so forth. So if you're a listener and you want us to talk about any other topics, feel free to email us, call us with any feedback, data points. Happy to address any of that stuff. So
Yeah, no, absolutely. The feedback is always appreciated. The comments, if you have any questions, as always, please feel free to reach out to us. We're here for you, and more to come in October.
absolutely.
Thanks, Bob.